Market Call continues with David Burrows of Barometer talking North American large caps. Hello again, Michael Hainsworth with you. 1-855-326-6266 is the number Don dialed in Ottawa. Hi, Don.
Thanks, Michael. David, I understand from professionals that the drug Opdivo, which is being marketed or being developed by Bristol Myers, is having great success. They've had a few minor setbacks, but generally it's an upslope. Can I have your comments on Bristol Myers or possibly Merck if you think that is better? Thanks a lot.
All right.
So, Don, I do a lot of work on sectors, and of course the pharma group sort of went out of favor 3-4 months ago. I guess it was in around July.
Wasn't that sort of the Clinton situation?
Well, there was Clinton comments. There was lots of discussion around drug pricing and in the political spectrum. And so you've seen that become a source of funds for people to rotate into other industries. Now, here we are, we're headed into year end, and we have a market where buying is broadening out into more and more sectors. And the healthcare sector seems to be catching a little bit of a bid. It's improving. So I think that if I were to say the sector is neutral to a little better, I think that would be a fair comment. Within the sector, Bristol Myers has had some disappointments recently. I would probably prefer to look at a Merck than a Bristol Myers. Merck technically sets up better. You're buying broad-based portfolio of products. And so realistically, there's probably a broader list of investors prepared to look at a Merck than a Bristol Myers.
Would you prefer to be in companies within that space, though, that are more making hip replacements, et cetera, that don't have to worry about, even Donald Trump said he wanted to bring down pill costs.
Yeah, so for instance, if you looked at the IHI, which is the medical devices ETF, it certainly has performed better than the PJP, which is the pharmaceutical ETF. The only thing that I want to say is that, the hard thing to remember is when you're in a bull market, and we're in a bull market, you want to focus on the things that people care about now. When I look at the moves that you're seeing in financials and industrials and transports, these don't happen very often. And so you don't really want to be focusing on the stocks that have been sitting it out, because you don't know how long it's going to go on for, but you do want to take advantage of it. So for a long-term investor, I think buy some Merck. I've got a little bit of Merck in our equity portfolio. We have a very low weight in healthcare because it's just not leading market. I think you're not going to get hurt, and you're going to get a nice yield. So take that for what it's worth.
Merck, by the way, dividend yield 3% on that $61.81 stock. Don, thanks for joining us from Ottawa. Local line in Toronto now for Larry. Hi, Larry.
Hi, good afternoon, gentlemen, and season's greetings. This has been an absolutely fantastic show. I couldn't agree more with everything that David has said right from the very beginning of the show about the overall market. My question is on Citigroup. And David, if you could please give your assessment of that stock, maybe a little bit of historical perspective of book value and price to earnings ratios, and how the business environment will change for the U.S. banks with deregulation, with increases to interest rates, perhaps some dividend increases being able to be made. And just if you can mention something about where the risk for subprime auto loans might be out there, if they might be more in the regional banks.
Right.
Thank you.
All right, we only have 16 minutes left in the program.
Okay, so Larry, it's interesting. We're 40 minutes through the show, and this is the first call on financials.
On a stock that's up 24.3% since Donald Trump was elected.
So look, here's some metrics, okay? The U.S. banks have averaged trading at about 2 times book value.
Currently 0.8.
So less than 1 times book. Okay, they have for many years at a time traded at 3 and 3.5 times book. Book value has been depressed because people have been very conservative in valuing their loan books because of all the regulation. Earnings have been held lower. Citigroup has 29,000 compliance officers. The billions of dollars that have been layered in cost due to Dodd-Frank and the new regulations is enormous. So you get higher long-term rates. It allows them to make a better net interest margin on the money they lend out. You get some less regulation. I'd equate this to going back to 1981, the beginning of deregulation in the Reagan era. If you have a little bit better tax rate, if you have a stronger employment picture in the U.S., which we are seeing, if you see payouts go higher, payouts on the U.S. banks are at about 25% of their earnings. They've historically been at 50%. So if you get earnings growth, dividend payouts going higher, the multiple that investors are prepared to pay is going to go higher. These are the types of companies that can double, okay? And you're not taking a ton of risk. There's a lot of skepticism in the market. They are under-owned by institutional investors. So whether it's a Citigroup or another name we'll talk about today, this should be a big part of portfolios in this market that we're in.
Stay with us for the top pick. So we still have more time, by the way, for phone calls. Don, Larry, thanks for that. We hope that helps you out. When we come back, we're going to go back into the local line in Toronto. We're going to talk about pharmaceuticals, maybe get into some other plays like that with David Burrows at Barometer. We're back after this short break.